7 companies now control 1/3 of the entire S&P 500. And if you own any index fund, you're dangerously overexposed. Let me show you the numbers that should terrify every passive investor. The Magnificent Seven: Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla now account for 33% of the total S&P 500 market cap. In 2015, just 9%. That's 7 companies out of 500 controlling 1/3 of America's most important stock index. How did we get here? Tech dominance. These firms are leaders in AI, cloud computing, semiconductors, and digital advertising. They've got superior profit margins and earnings growth that make the rest of the index look like amateur hour. When markets get uncertain, investors pile into these safe growth stocks. And the AI boom? It's been rocket fuel for Nvidia and Microsoft especially. Now, this concentration has driven massive returns. Without these 7, the S&P's performance would be pathetic. Their innovation engines, investing billions in AI and cloud infrastructure that fuel economic growth. During crises, they're seen as safe havens. But here's the problem, and it's a big one. With 33% of the S&P tied to 7 stocks, this index isn't diversified anymore. It's a tech bet disguised as broad market exposure. If Nvidia or Apple stumbles, they're dragging the entire index down with them. We're looking at potential valuation bubbles, massive sector skew toward tech, and regulatory crosshairs on big tech from governments worldwide. Any antitrust action or AI regulation could crater earnings and ripple through your diversified index fund. The bottom line, the Magnificent Seven turning into 1/3 of the S&P 500 is a double-edged sword. Great for returns during tech booms, dangerous when sentiment shifts. Your S&P 500 fund is now more concentrated and fragile than ever. Always follow Dhanda the Great on YouTube for latest stock market news updates.